Hey everyone, Anthony Venuti here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode we're going to talk about common mistakes first-time homebuyers make when going through the pre-approval process. You don't want to miss it, stay tuned. On this episode, I want to take an opportunity to go through some of the common mistakes that we see happening with pre-approvals and how you can avoid them and what you should be doing as a purchaser, first-time homebuyer, millennial, or even new to Canada individual looking to go out into the market and get a pre-approval. Now, not all pre-approvals are created equal, and we'll go through all that in this video. We had a situation arise not too long ago, just a few months back, where an individual had approached us after being declined by their bank. And they did not get notification of why they were declined. Generally, some banks can tell you, some banks won't. But this client approached us with their job letter and their pay stubs. They provided the T4s. When the clients had gone to the bank for their pre-approval, they had purchased based on that information. They had securitized it, purchased firm. Clients had bought well below their budget, but they used that pre-approval. And because it took some time for the lender to get back, the clients had to waive their condition. The deal ended up going firm. The person at the bank told them, yeah, not a problem, we're all good. Lo and behold, big issues arise. What happened was, with this particular scenario, when we got the job letter had very generic information. The individual was a commission-based individual. They had started less than a year ago, and the income bracket where it said salary basically just told them the whole amount. And nobody asked any questions at the time. But the individual actually had a base salary which was significantly lower plus the commission. Now, because this individual had just started with this particular company, well, the lenders will not use future dated income. And the pay stubs right off the hop, I noticed, did not annualize or did not match the actual annual salary. And we soon discovered that this was the major problem because the credit was good, everything else was fantastic. Long story short, this was a very easy catch because nobody took the time to look at the pay stubs. They just accepted the job letter at face value. And this was a major problem that cost these clients thousands of dollars. They ended up having to go with an alternative lender because they needed to close, and thankfully they had 20%. If they did not, this could have been a very sticky situation. So point number one is when you're going through the pre-approval process, make sure that you're providing all the accurate information. Have an honest and open conversation with your mortgage professional because this way you can avoid any future headaches. This is critical, especially if you're self-employed or you make income that is commission-based or incentive-based. You want to make sure that all that information is covered right at the beginning. And especially, as I mentioned, if you're self-employed, making sure that your taxes are filed, what income you're showing, and especially right now, if you're going out to get a pre-approval with tax season approaching really quickly, you want to make sure that your income taxes are filed and that if you can, bump up that income so that you can get a better average because self-employed individuals require a 2-year average on their income. So T1 generals, notice of assessment, articles of incorporation. It could be very well that not providing those articles of incorporation could jeopardize your deal. And we've seen it happen where clients say, hey, I've had this company for, let's say 2 years, but the 2-year mark isn't for a few months from now. Sometimes the lender will make an exception, sometimes they won't. You have to be very, very cautious. So point number 2 is actually talking about the down payment and deposit. Now, generally through the pre-approval process, we're going through the credit. You know, you're looking at those credit, you're looking at any of those items in there. Sometimes there's credit cards that were paid that are still showing up, maybe a lease that you paid out that was closed but not on the credit bureau or still shows on the credit bureau. A lot of things you're going through. You're looking at the T4s, you're making sure that those job letters, we're checking the verbiage on that letter, annualizing those pay stubs. But a lot of times brokers will hear, we'll have clients come to us and say, well, nobody ever talked to me about the down payment. This is why I'm in this situation. And obviously it becomes a lot more complicated once you're dealing with a firm purchase and now you're trying to pick up the pieces. This should have been done right at the beginning. So what we end up doing with our clients, and we go through all that process, a major component is having a conversation around that down payment and collecting the proper documents. If you have the money in your account or in several accounts, we always ask for a 90-day history of each and every one of those accounts of where the money is going to be drawn from. Because what will happen is the lender will ask for a 90-day history and they're going to scan those documents for large deposits. And if there are deposits in that down payment or in that account that are not able to be backtracked, you could run into some major issues. And you have to ensure that the money, let's say it's coming in from overseas, Well, is that money been in a Canadian account for 30 days or more? And when are you closing? Is it in an RRSP? Are you using your RRSP for the down payment? Have those funds been in that account for 90 days? Which accounts are they coming from? A lot of times, it's very important that you review the down payment. Now, there are situations in which you may have a portion of the down payment, the rest of it's coming in as a gift. Maybe you're getting some support from family. Obviously, those are things that we need to address and make sure that those funds are going to arrive and that you are going to get those gifted funds. Otherwise, you're not going to have your down payment. Now, as we're talking about down payment, part of the down payment is what you're leaving as a deposit. And this brings us to a question that we see or asked a lot of times with clients as we're going through the process. Anthony, how does the deposit work? Is it come off my down payment? Yes, if your down payment is $100,000 and your deposit is $20,000, for example, then on closing you're required to come up with the $80,000 plus any additional closing costs and legal fees. So all these things are going to encompass of your down payment. But the down payment is going to be required, the deposit, I should say, is going to be required with the offer once it's accepted. So the pre-approval takes you to the journey to put the offer on the home. Once you get the home and you say, look, we want to purchase this home, put in the offer, agree on the deposit, obviously agree on the price, you are required as the purchaser, the future purchaser, to put at least around, we say arguably around 5% of the purchase price as a deposit within 24 hours to make this contract binding. And we'll get into conditions of financing in just a moment, but with the deposit together with the offer to confirm that you're purchasing this home. And what happened over the last little while is I've been having these conversations with clients as part of my journey through the pre-approval process. And generally, most real estate professionals are very good at doing this and confirming, hey, do you have a deposit ready? Well, these particular clients, we had advised them when they started their journey, because pre-approvals are good for about 120 days. So we advised the clients that, hey, look, these pre-approvals, you have to close. If the expiry date is this date, the transaction needs to close by that date. And it had been basically about 2 months. They were closing within the 120 days. The clients had forgot that we had mentioned to them. They hadn't mentioned to me. They put the offer in. I got notified by the real estate agent that the offer was accepted. And the clients had basically lost the opportunity because their funds were in an online bank. It wasn't a brick and mortar location. They were locked up in funds, TFSA and RSPs, and they needed that money to be put into their account, and it would have taken about 4 days. So they couldn't actually complete the offer, which the client or the sellers had accepted. So this is obviously very, very important. So if you're a first-time home buyer, millennial buyer, even if you're a move-up buyer, anytime you're putting an offer on a home, especially on a resale side, that's just pre-construction, have that money in hand, ready to go, liquid in the account if you're in that process of buying a home. So very, very important. Down payment, deposit, overlook it, have the conversation with your mortgage professional. Now, finally, the major question with pre-approvals, probably the biggest question in this current market, and something that should go without saying. If you're a first-time home buyer, it all depends on your situation. The condition of financing is very important. As mortgage professionals, we will do our best to go over the credit, down payment, income, all that is bulletproof. But the one variable that's always outstanding is the property, the subject property. What will that appraisal value come in at? And the reason why we tell our clients to put either a 3 or 5 day window for financing will depend on if it's an insured deal with 3 days minimum, and if it's a conventional deal, potentially around 5 days, depending on the lender that we're working with, their turnaround times, and how quickly we will need an appraisal. If it's an insured deal, well, generally the insurers will cover the appraisal. It is usually done within the 3 days. If an appraisal is required with the insurer, well, they'll take care of it, but you may extend over 3. So that's why we generally say 5 days is a good opportunity. Now, there isn't a situation where if you have, let's say, a condo, there's a status certificate, there's other complications in that file, lawyer review, you may extend maybe 7 or 10 days. But generally the financing conditions are usually 5 days, unless you're able to get more. If you can, by all means, but 5 days is usually the minimum. And within those 5 days, you should be getting the appraisal report back or the confirmation on the appraisal, making sure that all the income documentation has been completed. And sometimes in this conditional period, there might be some things outstanding. Are they major or are they minor? Income, job letter, pay stubs, like all that has to be verified, credit, appraisal. There could be things outstanding such as, maybe the closing costs, all the down payments there, but but the closing costs are going to be coming in from your payroll once it's deposited into the account. But as we said, the condition of financing is there to protect you, the purchaser, in the event that that property comes in less than what you've agreed to pay for this property. And that is very, very important, especially in this changing market. Although we're seeing multiple offers and bidding wars and prices start to go over ask, the appraisals that are being completed may not yet reflect all these changes. And this is very important because we always get the question saying, Anthony, we were in an offer presentation, or we were in a situation where the person that we were competing against, they didn't have a financing clause, but you said that we need one. Well, why don't they need one? And to answer this question is obviously very challenging because we don't know who that person is, but we do come across these scenarios often. If you're a first-time homebuyer with a limited amount of resources regarding down payment, you're not able to get a gifted amount, support from family, you don't have a co-signer, you're working within those limits and those confines. But you could have individuals that you might be facing who have a significantly larger down payment. They might be qualified for a higher mortgage than what they need. There are so many different scenarios that are out there. And generally, that is why some persons or some people may not have a condition of financing. If you're, for example, purchasing a home and you're not concerned because you love this house and you're saying, Anth, a lot of clients will come and say, I love this house, even if it comes in $100,000 less, I'm still willing to pay for it. It's in the ideal location next to my parents. So, we got the extra money and we've done the math, we've done the numbers. The most important way to waive a condition of financing in an offer situation is understanding your situation. Knowing your contingency plans, knowing your exit strategies, and understanding that if this doesn't happen, what are your options? At the end of the day, if you have to take something away from this video, it's if you're purchasing a home, your confines to your down payment, your income are telling you what you can purchase for, and you decide to go into an offer without a condition of financing, you're doing it at your own risk. Now, before we end the video, I wanted to share some information with maybe some of our viewers out there that have already purchased a home and maybe they've secured financing and they have their rate and everything's ready to go. With the current events that have happened and unfolded in the US as a result of the banking crisis, which has had an impact on the Canadian bond market right here at home, well, you may be eligible for a rate drop. And a lot of banks, a lot of lenders will not just issue you the lower rate without initiating this conversation. And if you're working with a bank, you should be reaching out to your rep directly. And if you have a mortgage broker, understanding that you should reach out to them to see if you can initialize a rate drop. We've been doing it for our clients manually, letting them know as the rates have come down. But it's a very important conversation that we are having with our clients. And remember that not all the banks at this current moment have translated these lower bond prices into their fixed rate mortgages just yet. Some banks have not. And we'll do a mortgage rate update for April coming up in the next couple of weeks, where we'll take a deep dive on where interest rates were and where they are now and potentially where they're headed. So we'll leave the video here. We hope that everyone enjoyed this content. If you came into the video and you learned something that you didn't know before watching this video, we ask you to hit the like button, share this video with someone that may benefit from this content, and don't forget to subscribe to the channel and hit that notification bell. But until next week, we wish you all a great weekend, an even better Friday, and thanks for clicking, thanks for watching.